It can be very discomforting for investors when markets fall sharply. It's a natural reaction. Our brain reacts as if we're facing a physical threat. The amygdala, the brain's fear center, activates the fight or flight response, triggering the release of cortisol and adrenaline. This can cause anxiety, increased heart rate, and impulsive decision making. At the same time, the pre-frontal cortex, responsible for rational thinking, may be overridden by emotions, leading to panic-driven decisions we may well come to regret. The evidence shows us that in most cases, the best thing to do in these situations is nothing at all. Generally, our long-term interests are best served by ignoring the noise and resisting the temptation to act. It's simple advice that's hard to follow. I know, I've been there myself. It can be soul-destroying to see your portfolio suddenly fall in value. But I can honestly say, market falls no longer bother me at all. Why not? Because I've learned to reframe them, and I'm going to show you how I do it. So if markets have fallen and you're feeling anxious and wondering how to respond, here are 12 things to think about. 1. Downturns are an inevitable feature of global stock markets. In fact, it is effectively enduring these downturns that investors are rewarded for. Without uncertainty, there wouldn't even be an equity premium. No pain, no gain. 2. Don't catastrophize. When markets have fallen sharply, commentators often talk of market crashes and compare what's happening now to crashes in the past. But full-on crashes, in other words, declines of 20% or more, are relatively rare. 3. Markets can and do recover remarkably quickly. Yes, bear markets can last for a long time, but market volatility is often over within a few weeks or even days. A month or two from now, you may have forgotten all about it. 4. The market's worst days are often immediately followed by the best days. That's the nature of market volatility. Things can look very different within just 24 hours. And being invested on the best days makes a huge difference to your eventual returns. 5. Market crashes and corrections are almost impossible to predict with any accuracy. With the benefit of hindsight, it all looks so obvious. Commentators are rather better at explaining the reasons for market falls than warning us about them beforehand. 6. It's not just you who's feeling the way you do. It may seem an obvious thing to say, but we can forget when a market sell-off hits us hard that hundreds of millions of investors around the world are affected too. So don't take it personally. 7. You didn't make a mistake if you recently invested a large sum. You paid what was at the time a fair market price. You weren't to know that prices would fall when they did. So you certainly shouldn't beat yourself up about it. 8. Yes, its value has been marked down, but your portfolio hasn't changed. You own a share in the same companies you did before prices fell. For those companies, it's business as usual. They still aim to maximize returns for shareholders, and their underlying value is unaffected by market sentiment. 9. What if those predicting a worst case scenario prove to be correct and say we're heading for a recession? Well, from an investment perspective, it may be less disastrous than you think. Why? Because markets are forward-looking. The likelihood of a recession may already be priced in. 10. Even recessions can benefit the economy and share prices in the long run. Recessions act as a natural reset. They help correct economic imbalances, eliminate inefficient businesses, and force companies to become leaner and more productive. Ultimately, that's all good for share prices. 11. Throughout history, capitalism has shown itself to be extremely resilient. Markets have fallen many times, but eventually they have almost always recovered, even after world wars. Staying invested puts you in the best possible position to benefit from a recovery when it comes. The 12th point is my favourite. Think of a market decline as a supermarket sale. When you walk into your local store and discover that everything is cheaper than last time, you don't walk out, you're grateful that your grocery budget buys you more than it did. If anything, it's a cause for celebration. Exactly the same principle applies to equity investing. Look, I don't want to downplay any emotional discomfort you may be feeling as a result of a market downturn. As I said before, that's just how the human brain works. But it's very important to stay calm and rational. If you're tempted to reduce your equity exposure or bail out of equities altogether, please consult a financial professional. If you would like to speak to an evidence-based financial advisor, just click on Find an Advisor on the TEBI website and complete the brief questionnaire. Our colleagues at Second Life Financial Planning will put you in touch with an advisor with the specific expertise to meet your needs. Finally, if a recent market downturn has persuaded you that it's time to start investing, you'll find hundreds of educational videos on the TEBI YouTube channel. Remember, TEBI readers and viewers who open an investment account with InvestEngine and invest at least £100 receive a welcome bonus of up to £100. Just click on the link in the bio or YouTube description or use the promo code TEBI, that's T-E-B-I, TEBI. The information in this video is for educational and informational purposes only and should not be considered financial advice. If you found this video helpful, please subscribe to our YouTube channel and why not leave a comment as well. Until next time, goodbye.